The use of professional money and risk management is your foundation to financial success. Why? Money management will tell you how many shares to buy. It's the most crucial decision a trader or investor faces. It determines your risk and profit. It's a defensive concept that keeps you in the game to play another day. Risk management will limit your losses and protect your profits by using a stop loss and trailing stop. Some may prefer to use a technical stop. Welcome. My name is Joseph Barrington-Lew, and after a dozen years helping novice and experienced traders and investors, I've found that this knowledge, or lack of it, being the major reason why most lose money. I have in fact found two major reasons why traders and investors lose money, but before I continue, I'm obliged to share the following disclaimer with you. Please read it at your leisure. Now let's begin. Plan your trade and trade your plan. You must have a trading plan and a discipline to follow it. Fail to plan and plan to fail. You are destined to fail without a trading plan. Cut your losses and let your profits run. Close that trade the first opportunity evidence indicates you have made a mistake, and have a stop loss price level. When in profit, don't sell until the evidence indicates a reversal, and not gut feeling, peer pressure, or fear of loss. Use a trailing stop. Now there are four major components to a trading plan. What to buy and when. I will not help you with that tonight. There's enough people out there doing that already. How many shares to trade? It's called money management and should not be confused with stop loss placement. It's also called position sizing or trade sizing. Your initial stop loss, your exit price level, where you accept you got that price wrong, or that trade wrong I should say. It will minimize any losses. Now your trailing stop loss, your second exit price level when in profit, also known as a profit stop and maintenance stop. In most cases it will prevent a profit from becoming a loss and protect a good portion of your profits to trade another day. Now remember, just because you close that trade, it doesn't mean you can't jump right back in if it meets all your entry criteria again. Any questions? Email me at joseph@paconsulting.net.au. Now money management or position sizing answers the question, how many shares are traded? It is not stop placement, as some believe. That is risk management. Those two major reasons why most fail, in my experience anyway, is one, holding on to shares that are going down and then suddenly becoming long-term investors to justify their lack of action. They have trouble accepting they made a mistake. Something I shared with many hundreds of novice and experienced traders who have mentioned they have the same problem is this. Always assume you've made a mistake after buying that share. Some of the best traders in the world only get about 50% of their trades right. In other words, they only make money 50% of the time. The difference is they get out first opportunity when the evidence indicates they got it wrong, and stay in until the market indicates it is reversing. So when you buy that share, assume you are wrong, because the chances are you probably are, and find it will be much easier to sell if it is what you expected. Now this leads me to expectancy. Like position sizing, it's one of the most important factors in trader and investor success. Sadly, most have never heard of the concept. In simple terms, trade expectancy is the average amount you can expect to win or lose on each trade. Now let's say someone has a system that produces winning trades 30% of the time, and each winning trade on average nets 10%, while losing trades lose 4%, and each trade size value is $10,000. So as you can see, a $20 expectancy, it is a positive expectancy. So even if you produce losing trades 70% of the time, it may be frustrating, but has positive expectancy and will make money over time. Let's look at another example. You have a system that produces winning trades 60% of the time, and each winning trade on average nets 4%, while losing trades lose 6.5%. And again, each trade size value is $10,000 on average. As you can see here, we have a negative expectancy of $20. Everyone wants to be right, and this is just another reason why you should keep your emotions removed out of the market. Being able to track and monitor all of this and more is vital to trading success. Now, if your trade size is too large, a string of losses could force you to stop trading. If your trade size is too small, you'll be underutilizing your account equity and your performance will suffer. Finding the right balance is part of good money management. Over these many years, two rules have always been quoted as proven. Never more than 20% means if you have $25,000 as trading capital, never buy more than $5,000 worth in any one trade. Never risk more than 2% means if you have $25,000 again as trading capital, never be prepared to lose more than $500 per trade. But you must allow for brokerage. If, for example, your brokerage is $50 each way, then your maximum risk is now $400. The mistake many make is how to determine what your true trading capital is. The correct answer is available cash in your trading account plus or minus your profit or loss if all open positions were closed at their current stop. I hope you enjoyed this presentation. It was brought to you by JBL Risk Manager, and I hope you trial the program today. I wish you all trading success. Thank you.